Hello. Today we're gonna go over the homework we had last time, and after that we're gonna introduce partial ownership consolidation. For control, we are parent the company owns not 100% of the subsidiaries shares. And the next class we're gonna talk about multiple year situation, at least 2 years of partial ownership. That's gonna conclude the first stage of advanced accounting. So first, let's take a look at our homework. Okay, so homework is similar to the practice we had in class. On January 1st, 2014, company Big obtained, oh, that's not homework, that's homework. Oh yeah, sorry. Company Big obtained 100% of the company's small shares by paying 3 million cash and issuing 1 million shares of their own stock with $1 par value per share and $5 market value per share. Right before the transaction, Big and Small's financial statements are like below. So this is very much like the practice we did in class. We got to know the answers to the 3 questions. 1, what should a Big's balance sheet look like right after the transaction? What should a Small's balance sheet look like right after the transaction? And what should the consolidated balance sheet look like right after the transaction? We are asking us those questions, so let's do it one by one. So for Big, when we take a look at a Big only, basically what we are asking us is this particular question, right? What are the journal entry? What are the transactions involved? What happened to Big? Which we need to document, use journal entries. And because journal entries are what's changing the balance sheets of different periods, right? We have journal entries compiled together, affects different accounts. And then we also have closing journal entries, right? Which changed all the expenses and income items and dividend, of course. So here, if we read it, we know that in 2014, the first day of 2014, Big obtained 100% of the company's small shares, right? So Big got an investment. I'll write the answer here, right? So debit for Big, right? Investment. And what did Big do together? By paying 3 million cash. Okay, so for Big, we also know Big, what happened to the cash? By paying it, right? By using the exchange the cash with something else for the investment. So at least now we know the cash exchange was 3 million, right? Anything else? Yes, of course. By issuing 1 million shares of their own stock with $1 par value and a $5 market value. So here, let's interpret again, right? If we, by default, they issue, right? They issue the shares to those who give up their small shares, right? So those who give up their shares in small, they are no longer directly related to small, but they became shareholders of Big. See that? To them, their value is not. They're probably better off because they got something other in return, right? They received 3 million from Big, and they received a certain amount of stock in exchange. As a catch, they give us their shares in small, right? So we can see that by talking about this, we know that basically Big issuing those shares, right? We know that there's no income, there's no expenses, and there's equity because Big got more shares outstanding. Big issued more shares, right? So what are the value of the shares issued? 2 things. One, we know it's 1 million shares and $1 par value. So we know that it's 1 million here because it is the face value, right? 1 million, $1. And then now we know something called additional paid-in capital, which is the difference between the market value and face value, which is 4 million. So we know that the total investment, oh, sorry about that. The total investment is worth 8 million. I don't know if you got this right, but why 8 million? We can also think of another reason like this, right? Had Big didn't give it to the former shareholders of Small, but it felt it directly. They can raise 5 million cash, right? So by giving up the shares, Big gave, it's the same as Big gave $5 million plus a $3 million they give in cash is $8 million. So this is $8 million, right? So that's the answer to the first question. Second question, what should Small's balance sheet look like right after transaction? Again, what happened to Small? Did Small get anything? Somebody might say that, okay, it seems Small received the cash and got the shares of Big, right? Think about it. I ask you this one more time, right? If you own certain shares of Google, right? Just like small shareholders. Now you sell your shares. Who received the cash? Does Google receive the cash or do you receive the cash? I think the answer is quite clear if you sell your share, right? I talked about again, notice, be aware of the difference between legal person, which is business, and the actual person, which are the shareholders. There's a difference, okay? So for Small, Small didn't get anything, right? Small didn't get anything, Small didn't gain anything, Small didn't lose anything. So there's no journal entry for Small. So this is quite straightforward, right? And A. Now, what Big's balance sheet look like right after transaction? We know they lost the 3 million cash. So cash becomes to change to 2 million. Nothing happening to this one. Nothing happening to inventory. And nothing happened to PPE. Nothing happened to patents. It's the same day. And investment, we know they give up certain things. They got an investment. What's the value of the investment again? $8 million, right? That's for Big. Now loan, nothing changed. Common stock, it used to be 1 million. Now we know it's 2 million. Additional paid-in capital used to be 3 million. Now it's 7 million. Retained earnings didn't change, right? We don't need any equation to figure this out, right? So if the balances, you can see from here, if the balances, so it's good. At least not horribly wrong, right? So what is a consolidated balance sheet right after this? Again, we talked about market value and book value. I'll say that when we do the next one. So here, total cash becomes, there's no difference in market value for cash and between market value and book value for cash, right? So accounts receivable becomes 13 million. Inventory, it is 11 million. PPE, what is PPE, right? PPE, 10 million for Big, and book value of 3 million, market value 1 million. We know we should use market value, so it's going to be 11 million. In fact, patents, same reason, it's going to be, it's going to be 12 million. Investing in Small, so let's think about it. What is consolidated balance sheet? Consolidated balance sheet is to tell financial statement users what the whole group, which consists of Big and Small together, what the whole group has, how their operation was. For the whole group, right? For the whole group, there's no point talking about investment because Big is investing A. It's just like you talk to check your pocket, right? When I ask you what is your total wealth, you tell me $8 because you may have $8 in your left pocket and nothing in your right, or you have $5 in your right pocket, 3 in your left. They don't change, right? Your total dollar is the same. There's no control, there's no whatever. So from this, we know that Big and Small together, if we talk about Big and Small together, a whole group, right? A whole group, right? There's nothing talk about a big investment in Small because there's no such thing, okay? So investment becomes 0 for sure, and goodwill. Goodwill, we will need to figure it out, right? How to figure out goodwill? Let's do the calculation, okay? So we know that essentially it is like $8 million. Remember that? We said it is like $8 million big paid. Big paid $8 million. They got 100% of small, right? So they got everything of small. The definition of goodwill is those cannot be, pretty easy, cannot be named, right? Unidentifiable. Once you can name it, it's identifiable. It's identifiable, right? So there's a difference, okay? So big paid for different assets, right? What big got was, okay, we got a market value of cash, accounts receivable, because we buy from the market, it's market value, and we got a PPE patent and everything, okay? Everything. And we assume that 15 million loan, right? So the total asset market value assumed was 21 million here, and loan was 15 million. So net was 6 million, right? So the net they got was 6 million. So what it tells us, goodwill, net market value of identifiable assets is for 6 million, and the liability was 6 million. So here we have 2 million, right? This is what they paid more than that. They don't know what I paid for, but I paid more, right? So here we got a 2 million. So we know the goodwill was 2 million, right? And here, the total liability don't really change. It's just total of both, and we talked about it. The equity item of the consolidated group equals to whatever the big, because big's calculation includes those investments already, right, number-wise. So here, let's take a look. Add up to 0. We seem to be fine, right? So that's our homework. The answer to our homework. Okay. Let's talk about some new things today. As you can see, now it's getting a little bit complicated, but it's still based on our form, the previous question. This is generally the form I like. I like to make things this way. So this is case. The difference is, in this case, we see that a company big paid, company big obtained 60% instead of 100%, right? So this is pretty common for a company to control another company, for company big to control. What's the point of control, right? The point of control is not to make money off its stock. If the money is like that, big don't have to buy 100% of the shares, because the rule of investment is diversification. Diversify the risk and make more money. Don't put all your eggs in one basket, right? And plus, if you buy so many shares, able to control the company, you cannot easily get out, even if the share price crashed, right? So we know that a company big buy shares of company small. The purpose is not for the money, it's to control. Making money is good, but control is a point for something other than money. Money is just one of it, right? Controlling, to use big small assets, to use small resources, like to use small, maybe the connection market share, all these different things, right? So to use these, what do we mean by control? Meaning that a big can use smalls as if it were their own. And when does big have control? Only if big has 100%? Of course not, right? We know in a lot of cases when we say control, we are saying that, hey, if you're voting, you own more than half, you're controlling because you're going to be the boss, right? So big don't need 100% ownership. And in real capital market, nobody needs 100%, right? Unless they have other reasons. So here we are assuming 60%, right? 60%. So that's one thing we got to keep in mind. Let's talk about the second, right? Let's say company big. Let's say company big, right? Let's say company big uh, owns 75% of small. I know in the question we said it's 60, but here's another example. We are saying that the company big owns 75% of company small, right? And company small has a Cadillac. Let's say I like Cadillac. Okay, let's say company small has a Cadillac. So can company big control company small to Cadillac? Can use Cadillac? Of course not, right? Do they use only 3 wheels or all 4 wheels? Do they control 4 wheels? You see that? What am I talking about? You know, the consolidated financial statements, right? We are talking about the balance sheet. We're going to talk about income statement, but the balance sheet is showing the whole picture of big and small putting together. You see that? As long as big controls small, there is consolidated balance sheet from big's perspective, right? The consolidated balance sheet or consolidated income statement, they show the performance, show the whatever condition of big and small put together. So regardless of big, so for example, in this case, right, 1 million cash, 5 million cash here, okay, that's not good example. 7 million inventory, 4 million inventory here, right? So no matter it's 100% or 60% or 51%, we know small has 4 million inventory and a big has 7 million inventory. So together they have 11 million inventory. Can we see that? All right. So this should be clear to everybody, in my opinion. All right. So let's do it. Let's move on. Okay, let's move on. I always say that when we do accounting, when we need to understand it, after we understand it, it's better we practice, right? Learn from the practices. It's better, more efficient, more effective. But if we know we learn, we practice in the purpose to learn, right? For the purpose of learning. So keep that in mind. Okay. So what should a big balance sheet look like right after the transaction? That's the same question, right? Let's do it again. Is that hey, right? This time they got 60%. Okay, 60% of small. Where are the numbers? Right. So to get 60%, so it's the same issue, right? Debit, investment, of course, credit. What do we credit, right? Big pay the cash. Again, 3 million. And we know that, again, common stock. Common stock, we know it's 1 million. Additional paid in capital, 4 million. All right, so there's no change. We will have change, but not for now. So let's take a look. Oops. And for the investment, how much was the investment, right? Investment is a total. How do you value how much the investment, right? Big paid 3 million cash. Big also issued common stock, 1 million shares with market value of 5. So total 5 million plus 3 million, still 8 million give up. So 8 million investment account they got, right? So here investment, 8 million. And we know cash is lower by 3, so 2 million. No difference, right? I don't like things with too much difference. I think it helps us, just understand better when we keep it questions a bit more static, and it's easier for us to compare all the differences, minor differences, see the subtle change. So this is Big's financial statement. What their financial statement look like right after the transaction. Can we see that? Add up to what? Oh, sorry about that. Yep. So that's why I pull them together. The total should be zero because total debit equals to total credit, right? Total asset equals to total liability plus equity. So when I miss something, when I look at those pulling together, I see the total is not zero. I know I must have made a big mistake, so I can correct it. Checking is important, right? So next the thing, right? What should a small balance sheet look like right after the transaction? Again, no difference. Here, again, no difference because small didn't get it. Can you see that? Hmm? So now things get a little bit more fun. Okay, things got a little bit more fun. All right. So we know when big buys small, big as although small didn't change. What do we mean by subsidiary? Subsidiary by law is still an independent company, operation-wise. Okay. So from small's perspective, we didn't receive any money, we didn't give anything. It's just shareholder change. And of course, you can imagine, right? That companies like Google, Microsoft, Tesla, how many people are buying and selling their shares? Do they make a change? Journal entries for these? Of course not. The company remain intact. Can you see that? Right. So based on this, we know small's balance sheet don't change. Again, small don't change anything. However, when big pays money for small shares, right? With a big, of course, has its own way to place value, to give a value, place a price tag for small, right? So how do we know it's too much? How do we have an idea it's too much and for what, right? Some assets, when we can name it, cash, AR, inventory, PPE, patent, land use rights, land, whatever stuff. But when we can name it, we know it's called identifiable assets and liabilities, right? So they have their market value. For something other than, for something else, right? Like for some political connection, good employees, experienced loyal employees, you cannot really name it. First, right, you can put another human beings on balance sheet. It's technically wrong, politically wrong as well. You cannot sell human being, you cannot price human being. And second, political connection sounds too bad, right? You don't name it. So we give it a fancy name called goodwill, right? Basically what we are saying is, hey, you know what? On balance sheet, there's something that can be identified, right? Item names. For those cannot, let's call it goodwill, okay? So we need to know how much is goodwill. And go back to what we talked about. The consolidated financial statement is for big and small together, right? Together, not partially, but putting together, okay? So we know that, okay, big paid, how much? 8 million. You know what? I don't like this number. Let me change it to 80%, so the calculation is more friendly for me. Heck, 60 or 60, whatever. Big paid 8 million, right? Amount and percentage for 60%. 60%. What does it tell you, right? Big paid 8 million for 6% of something. Is my understanding correct? Right? So if you are willing to pay 8 million for 60% of something, then what is the total value of that thing from your perspective? Let's name it total value, right? If you pay 8 million for 60% of something, I guess in your eyes, the value of that thing is this much. The number is ugly, but sorry about it. Let's, you know what? Let's change it to 80%. It's just much better. Okay, it won't change anything. I mean, it won't change what we talked about, right? Let's assume it's 80%. I bet. Usually in the exam, the calculation will be very friendly as well, so no need to worry about these. Okay. So first we ask, right? what is 100% worth? Big paid 8 million for 80% of small. So the total package of small is going to be 10 million, right? It's 10 million, right? Meaning that a big is willing to pay 10 million for the whole package of small. We got that? Okay. Now, small net market value of identifiable assets and liabilities, right? Assets and liabilities, how much we know. Okay, market value of assets are here, market value of liabilities are here. So the total package is 6 million. So on top of what's identifiable, big pays 4 million more. That 4 million must be unidentifiable, and we call it goodwill, right? So for the consolidated, we know the whole package. Remember why we have to go from 80% to 100%? Because we talk about the whole group with all of A and all of B together, right? So here we know how much? 4 million. And we have these things because the whole group has access to cash in the amount of 3 million, has 13 million accounts receivable, the whole group, right? Not B, the whole group. Although from B's perspective, B is the boss of the group, but it's a whole group, right? Inventory is 11 million, PP 11 million, patent 12 million. Again, there's no investment, all right? We talked about these. And then the total is looking good. Of course, it's not a balancing yet, right? It's not a balancing yet. So again, we talked about this. We know the equity item don't change. Oh, sorry about it. We know the equity item don't change, okay? So we will still be missing a number, and we can discuss where the number should be from, right? We are missing roughly about 2 million. So let me ask you, right? Let me ask you. So we said the balance sheet is from Big's perspective, right? The consolidated one, all right? So when we talk about common stock, we are talking about what matters to Big. Okay? It's common stock to us. It's additional paid capital to us. It's retained earnings to us, right? So here, when we talk about equity items, common stock, additional paid capital, retained earnings, they all belong to Big. However, remember, Big only controls, when we talk about group, right? We know that, of course, Big's owner owns Big 100%. Big's owner also owns 80% of Big, right? Keep in mind, there's 20% that don't belong to the shareholders of Big, belong to other people, right? They are not controlling, they only have 20%. They are sitting there passively, right? They are not controlling. So we call them sorry, too many typos. Controlling interests. You can call them NCI if you want. My point is we cannot ignore those people, right? We cannot ignore those people. For the reason we explained already, when we talk about Big's own stock, when they talk about their own companies, shows their shares in small already. So their equity don't change. Their equity items don't change. But remember, in the whole group, beyond whatever belongs to Big, right? When we look at equity items, there's a small part called NCI. How much are these? How much are those people's value worth in the eyes of Big? Because consolidation is from Big's perspective. Keep in mind, right? It's similar calculation. All right, similar calculation. Big paid 80%. Big paid 8 million for 80% of small, right? So the total package is 10 million, but Big only owns 8 million. You see what I mean? So the other folks, their value is worth 2 million, right? 10 million, subtract 8 million is 2 million, right? So let's put it here as equity, right? The equity, they own parts, although they are not the boss, they own parts of the company, right? Of B to be of small to be more exact. Right? Now I think they should balance. Yep. Okay. So today we stop right here. I will upload in the practice, and later this week this weekend I will upload another video talk about 5 steps and a multi-year. Hopefully it's going to help us quite a bit. So once we finish that, we can process. We will have a meeting this week, next week, and we're going to process, prepare for the midterm. Okay. All right. Thank you very much. Bye bye.